regards to overall recommendations for products, a notice of full disclosure and transparency needs to be made and needs to be sent out to all clients and affected parties to clarify any potentially hidden fees and risks in returns on products, such as the ISLD, which in reality does have significant downside and limited upside. Now, when a sponsor says they don't understand the assumptions and limitations of their own product, that's a red flag. So every fund DGIM deals with has to do the proper due diligence with respect to its product's performance and suitability for clients. Woodman's decision to not disclose his change in strategy for the WIEF from a large cap mandate to an emerging market strategy is not okay. Clients must always come first, and suitability of the product for the client must be prioritized.
So I will introduce the main issues of people, and they have misrepresentations, conflicts of interest, and confidentiality. Misrepresentation part. First, we can see DGIM did not disclose leadership change, Gabby retired, and actually not co-CIO, and obscure important fees, misaligned management, insensitives, and deceive clients act on the non-public information guaranteeing medium return of the investment product ILSD because there is a 50% chance that the ILSD will not achieve the medium return. And for the conflicts of interest, we can see the leadership team acts fiduciary mindset of managing assets and money for clients, and leadership team lacks integrity, honesty, and fails to put clients first. They did not find a competent CIO, but tell client that we exist co-CIO. And for confidentiality, we found that the executives should not disclose the confidential information about clients, even if they did not sign the agreement. Like Gwinnett should not disclose to Dorsey about PC's information, even Gwinnett did not sign the agreement. And the corporate officer of DGIM should not act on the non-public information. Dorsey should not encouraging clients to investing on KC stocks, especially Dorsey knows that KC stock price cannot go down aloud in the future and cause economic loss to their clients. So we recommend this DGIM disclose leadership changes, not co-CIO, but actually can be retired, and try to find a competent, qualified CIO with skills and experience. And restructure fees. So clients management, their perspective, their interests are aligned. And then Tom will summarize the recommendations.
Thank you, Yufan. We have presented a number of ethical violations, but without a change in the tone at the top, it's hard to imagine how DGIM can survive. They need to hire a qualified CIO, a better internal control environment, employee training and compliance. It's a long list, but essential for success as a firm and critical for gaining the confidence of their clients and maintaining the integrity of the profession. And now we're ready for questions from the panel.
Thank you, judges. You may start.
Thank you. I'm Curtis Kimball, and by agreement, I'm starting first in the lineup of judges' questions. My first question to you folks is, as you went through this case study, and we admit that it's a dumpster fire in many ways, did you see some cases where the standards overlapped, the actions taken violated multiple standards? And if so, could you give me an example of where you saw that?
Well, I think a lot of things overlap because, maybe the first standard is professionalism. And so I feel like everything kind of falls into that general category, but the way I read the code of ethics is things kind of narrow down from broad professionalism standards into more specific things like material non-public information. So, you know, on the one hand, they're lying or deceiving, and on the other hand, they're trading on insider information. So yes, I also had a hard time kind of separating.
That's fine. Yeah.
Oh, okay.
Good point. Thank you.
Hi, Team One. This is Marilyn Kimball. Good job on the presentation. My question is, could Dorsey and Gamby have changed their actions to avoid a standard? Could you give me an example of how they could have changed their actions to avoided one of the standards that was kind of outlined in your presentation?
Anybody want to take that?
There's many examples. If I could, have kind of one and have you walk through the thought process of what is wrong, what could have been changed to make it right.
Well, to me, it's on page 1 when it's very clear in the case that Dorsey and Gamby are telling the portfolio managers, hide stuff from your client. I mean, to me, many of the violations are don't do that. Like when Marion Gamby says to Jack, I'm retiring, but let's not tell anybody. I mean, to me, the corrective action is tell people. So it's in my mind, most of the violations are stop or don't. I don't know, Sarge or Yufan, you might have a better example than that.
No, I mean, a lot of these issues were problems with disclosure and, related in some sense to that. So just don't do what you're not supposed to do,
Yeah, and I also recommend that they should strengthen their compliance programs and, for example, set up more procedures, policies to strengthen their environment, their corporate environment, so make everyone understand their duties and have a ethical mind, especially when they set on the C-level and executive positions.
Okay, thank you.
Hello, Team One. This is George Chen. My question is, in your opinion, who was the worst violator in this case and why?
I will say that Whitman, and Whitman is the worst person because as a candidate, he actually knew all of these principles, but for his personal interest, he chose to put himself first and allow Dorsey to deceive the clients. Start from tell Dorsey about the non-public information of PC, and then Dorsey is next to Whitman. Dorsey actually worked with Whitman to hide the truth to deceive clients. So I think I think Whitman is first and then Dorsey.
By the way, these are all taken from actual things that happen. We can talk about that after the presentations are over.
Thank you.
Oh, Sergeant Tom, do you have different opinions?
Completely agree with you.
I feel like we met at least 6 CFAs in this case, and all of them have problems. I don't know that there's an example of a I don't know if there's a good example of a CFA. But I do want to emphasize the tone at the top. I don't know who's worse, but it's very clear that Marion Gamby was concocting a scheme to retire and not disclose it. So even though we are led to believe that DGIM has had a successful run for 10 years, it really makes me wonder, have they? If they have, that's great, despite all the ethical weaknesses and lapses in judgment and poor character. On the other hand, if they have not truthfully had a good run and the whole thing is a cover-up, this would not be the first time somebody ran a scheme for 10 years and got away with it before being discovered. So I would say it's Miriam Gamby, because she started the process by saying, I'm retiring, but let's create a plan to not tell anybody.
I did say these are from actual incidents, but they do exaggerate certain issues.
Thank you.
Any more questions?
No, I'm fine.
Well, team one, thank you for your participation. Unless someone else has another judge has an additional question, we may move forward with team two. Any other comments?
How much time did we use up in the question Q&A?
We have 3 minutes left.
Okay, thank you. No, I have no further questions.
Okay, wonderful. And so at this time, we will move the judges into their green room and begin a estimated 10-minute break. Thank you. And team one, of course, you can stick around for the next presentation.
Awesome. Thank you.
Thank you.
Great job.
Thank you very much.
Thank you for presenting.
Wonderful.
All right. So, hello, my name is Mia Iverson. And today I have joined with me
Francesca Rivera. And hi, good morning. My name is Angelica Martini. Today we will be talking about maximizing ethical practices in finance, which we know it is imperative for us to make a critical analysis of our financial actors' behaviors and actions. Therefore, in this case study, we can move to the next slide. Therefore, in this case study, we have specifically looked at the interactions of Dorsey and Gamby Investment Management, the Snake Fund, Barks and Stevens, and Woodman Income Equity Firm, and specifically probing for the CFA, their alignment with the CFA Code of Ethics. In this presentation, we will specifically identify the ethical violations committed by each of the firms, help our audience understand and explain some of the ethical issues. We will then transition and present our solutions and action plan and conclude with why ethics is important within finance. So specifically identifying the violations. So from philosophy's first principles, we know that breaking the social contract of ethics is, if it's broken one time, then it's probable for it to be broken many times. So what we wanted to do is present the plethora of ethical violations that have been committed by each of the firms throughout the case, and we'll delve deeper into this later on in the presentation.
All right, so now let's get into understanding and explaining the identified violations. So this table that you're seeing on your screen is to show the frequency of the violations that we have just presented. And so particularly, we went based upon the different standards within the Code of Ethics, and we checked off each one that was shown up in each scenario within this entire case. And so as you can see, what Angelica already said is that, you know, if something happens once, it kind of tends to be a domino effect and something else is bound to happen within that same scenario. And so that leads us to evaluating a little bit deeper into these different scenarios within this case under the Dorsey and Gamby Investment Management. And so this first scenario is particularly with Dorsey and Gamby. And the quote that we have taken from the excerpt is, "We will not tell them that I am retiring. Instead, we will announce that you are being promoted to the position of Co-Chief Investment Officer to DGIM." And so the particular Code of Ethics that we saw a violation was misrepresentation. And so when they're working with their clients, they're now going to be telling them that Dorsey is the Co-Chief Investment Officer of their company, where he's actually only doing the upfront work as far as the meetings and presentations. He's not actually equipped to do the role that Gamby is retiring from. And so it's a misrepresentation to their clients that he has the abilities and the knowledge to be able to do that role.
Awesome. Now moving on to Andre Northbutt and the Snake Fund. We specifically found this scenario problematic because Northbutt Securities is both the executing broker and the sub-custodian for all of the Snake Fund's trades. And as well, Northbutt is netting all of the outflows, which from the principle of internal controls of finance, we know that this is a failure to separate duties and therefore is a practice of market manipulation, which corresponds to Code of Ethics Section 2B. We also can say that this is could potentially lead to inappropriate behavior and overall fraud, which is why we have flagged this specific scenario.
Yes, and so then we moved on to Skip Madison and the conversation that he had with Dorsey. And he talked about a new product that he was trying to build together with Dorsey. And he ran some tests on the product and he got the information back to Dorsey's managers as far as good results, bad results. But he didn't share that with the clients. The only thing he shared with the clients were the benefits that they were going to get from it. They didn't share the actual testing results. And so in that case, then we have the performance presentation. So not really letting the clients know how well is this actually going to work, and is it actually going to work for me? What is the details that you're not telling me? And so that them sharing their performance presentation was not well.
So now going on to Ford Woodman, within this paragraph, we see clearly a strong violation of Section 5B, which is communication with client. And in this case, regardless of Fordman's confidence in himself, we believe there is no excuse to respecting the rules because the rules are the rules, and it's imperative that clients are aware and are informed about any change strategy that might impact the investment. Maybe some of them are risk averse, depending on so many factors. We believe keeping the information, the change of strategies is not fair and might not suit the client, which is why I really thought highlighting the violation of 5B was very important. So going on now to solutions, we believe that these are some steps, like given that we serve here as advisors to Dorsey, he's been the person who's had all these conversations with the feeder fund investors. We believe that there are some steps that he should take that can at least save himself and help the company as well. And number one, we believe that he should report effective immediately to the CFA Institute. This is the time where he has to set the right course. He's aware of what's been happening and actions must be taken. And step two, we believe that this is where we have to clean up everything that's been happening, and he has to break the existing relationship with the feeder funds because clearly so much has happened, so much manipulation, rule breaking, a lot has been going on, and this is the time where he has to completely stop his relationship with this feeder fund. And then number three, which is step three, I think it's very related to step two. This is where he has to provide alternative investment strategies that meet ethical standard, because it's one thing to break all those relationships, but it's another now to have replacement, like what are options now? And this is where also step four comes in, where he has to communicate with clients. Now that he's aware of what happened and he broke the relationships with those feeder funds, and he came up with options and alternative. This is when he has to disclose the information to client, where some of them obviously may be like, well, I really don't care because I've been getting great returns. But then this is when you think about long-term impact of those ethic violations, and it has to be clear to the client what's been happening. And so disclosing the information will be very key here. And then lastly, he has to set policies for future partnerships and set legal actions. So this is where, like in the future, whenever he plans to partner with any feeder fund or any other fund, really, something has to be known about with compliance. This is what we do. This is how we have to respect the rules. And in case this is not respected, these are some repercussions. These are the consequences of your actions without if you do not respect compliance. And so now, lastly, going on to the importance of ethics in finance, we just strongly believe that it's very important to be reminded on how the CFA charter holders around the world are people who are coming on together from different parts of the world and standing on standard and high ground of ethical practices, establish a stable and prosperous global economy. And then number two, we believe that it promotes trust and client satisfaction, because the whole goal of investment is to always put the needs of client first. Like, it's the fiduciary duties of investors to always, in all situations, to put the needs of the client first. And holding strongly to this standard shows how valuable and how you're really serving the client yourself. And then lastly, it does improve the outlook of the thank you. Yeah, it does improve the outlook of the financial services industry. You know, in the past, with all these crises that have happened, the 2008 financial crisis, all those cases that have happened in the future have really left the financial services industry questionable in terms of ethics. And holding on and always keeping this standard shows how much the industry is trying and is trying to be better. So that's it with our presentation. Thank you so much, and we are now we welcome your questions.
Judges, you may start.
Hi, Team 2. This is Marilyn Kimball, one of the judges for today. Thank you for the presentation. Just want to talk a little bit more. Maybe you could delve a little bit deeper into the situation with Bark and Stevens. You know, that's the situation where they're talking about a new product, and there's a lot of different parts to that part of the case. So I'm wondering if you could take a minute or two and kind of walk us through your thought process on things that were wrong, and maybe how things could have been changed to conform to the CFA standards.
Yes, absolutely. So I think from that particular scenario with Bark and Stevens, it was more of the actual tests that they ran on their products. So they put the product together and they wanted to see what were the possibility of returns, what were the possibilities of what is the benefits for the customer, but also benefits for us. And so they came back and they wanted to be able to say that the customer would be able to get 40% in returns. And in reality, there was only like a 50% chance that that could possibly happen. But when they shared it with the clients, it was more of actually you get that 40% over time. When in reality, after their tests were ran, that wasn't a possibility at all. So it was being able to see how exactly can you change that information to where you tell your clients, you have to let them know what are some of the risks after you've taken those tests and you realize, we did this and this was the term we wanted, but this is where it's not at. And then on part of Bark and Stevens, that might have just been a part where they needed to go back and look at the product and figure out what they could have changed to make it better to actually get up to that 40% and have the accuracy of that 100, maybe not 100% actually happening, but more than 50%. So I think that was the big thing we took away from that scenario.
Okay, all right, thank you.
Hi, Team 2 members. I'm George Chin, one of the other judges. My question is, in your team's opinion, what were the two worst violations of the ones you encountered in this case, and why?
Yeah, so I can specifically speak on one, and then possibly one of my colleagues can hop in and say which one that they thought was the worst. So there was a situation in which Dorsey was speaking with Woodman and had disclosed that they had funds specifically tied to, or had investments specifically in a fund tied to a fund that they were discussing, and had said, you know, oh, wait a minute, let me, you know, pull my money out before you make those changes. And so that was specifically on page 7 of the case study. And I think this is particularly unethical because I think like that interaction in itself is obviously not really in compliance with the code of ethics, and to an extent could be like some type of conflict of interest, right? If you have some type of family members whose money is invested into a company, into a feeder fund in which you're working with. And I also think like the part of disclosing that information and saying that, or, you know, telling that person to act unethically because of your own self-interest is just overall not right and breaking the code of ethics. And I'll let Mia and Princess jump in with their views.
Yeah, so the other one, the other violation that stood out to me and I believe was very recurring in almost all the 4 cases was misconduct. I thought there was just this clear behavior that was not for the benefit of the client, and all those investors kept behaving in a sort that, yes, we are confident, like this is what we've been doing over a period of time, and there was no question on how, yeah, is this right or is this wrong? And to me, that's really stand out as misconduct, and you are manipulating, and all these other things come in, like where the fact that you're behaving in such a way, you lack loyalty, you lack communicating with clients, you just lack transparency. So I believe that that's the one that really stood out to me in almost all the 4 cases.
Thank you.
Hi, everybody. This is Curtis Kimball. My question is, would you mind going to slide 7 of your presentation? I noticed that there are 7 standards. I noticed that you had the first 5, and obviously this case is designed to be exaggerated so as to show these issues, but they're also based on actual events that have occurred. Could you tell me a little bit about the other 2 standards, 6 conflicts of interest and 7 responsibilities as a CFA Institute member? Do you think there might be some cases where those would also be applicable to the situations that you've identified as standards violations? And could you give me an example, perhaps, where you have multiple standards violations in this case?
Yes, absolutely. So I think particularly for this table, we went based off of the violations we identified at the very beginning. So that's why this table only lists standards 1 through 5, but definitely there were obvious situations within, particularly the situation that Angelica mentioned earlier about the relationship with Woodman and Dorsey, because they are working together through this investment. And then there becomes this conflict of interest when not only they start to work together to be like, okay, well, I'm closing the fund. And he's like, oh, well, let me take my money out before you do that. And so that's a conflict of interest because now it's not more of a business thing. They moved it to personal.
Yeah.
And so that was definitely one of the violations of standard 6. And then I think moving towards standard 7 is even deeper into that scenario we have where Woodman is telling Dorsey about this new construction project with a different company. And he's giving him all of this information. And he's like, well, did they have you sign a non-disclosure before you shared this with me? And he said, no, I refused to sign it, but the company told him their information anyways. And so then that becomes to the duties of not only Dorsey, but also Woodman. Even though he didn't sign the non-disclosure, as being ethical, you have to understand that you can't share that information regardless, even though you didn't sign it, just because now you have a leg up on that company. It hasn't even presented their side officially to everyone. And so now Dorsey was able to take that benefit and let their clients know, oh, take your money out of this fund. They're not gonna, there's some inconsistencies within their model. And so that's information that wasn't public knowledge yet. And so that's where it got to be more of responsibilities for not only Dorsey, but also Whitman with Standard 7.
Yeah, this case study is a dumpster fire, so there are many overlapping violations.
Yes.
Thank you.
We have time for one additional question or a few minutes, 1 minute remaining. If no further questions, we can say thank you for a wonderful presentation, and we can move forward.
Yes, thank you.
Thank you, Team 2.
Thank you.
All right. Good morning, CFA Society of Atlanta. Thank you so much for having us here today. We are Team 3. My name is Nicholas Welsh. My teammates are David Williams, Caroline Kunitz, and Marcus Wilson. This morning, we are going to be looking at the Dorsey-Gamby investment management case. We're going to examine this case utilizing an ethical decision-making tool known as the Foursquare Protocol. Next slide, please. So for those of you who are unfamiliar, the Foursquare Protocol is an ethical decision-making tool. It was created by Stephen Goldman. He was a law professor at Catholic University. His idea with the Foursquare Protocol was basically to create a tool that helps organizations establish policy and then guidelines for adherence to that policy. We really like this tool for this challenge in this case because it helps decisions with our leaders with those decisions regarding kind of gray area, the conflicts of interest, misconduct, and drilling into the specific violations of an organization's code of ethics rather than kind of painting with a broad brush. So quite literally what our challenge is here today. Next slide, please. So when you look at the Foursquare Protocol, it's broken into 4 elements, or steps, so to speak. First, a description of the situation, understanding what is before you, painting a picture. Next, you would gather accumulated experience from similar situations, prior experiences. You would then draw parallels between your current conundrum and those situations and scenarios, and then recognize the distinctions between them. That would lastly put you in a place where you could position yourself to make an ethical decision. And I think by following these protocol elements, leaders make decisions that places an importance on justice and verdant decision-making. It allows them to use both intuition and reason rather than relying too heavily on one or the other. I think, moreover, this method forces a decision maker to see how their own self-interests may be influencing them. Next slide, please. All right, so let's jump right in for that, that element number 1, that current situation. And I want to introduce a concept here called leaders casting shadows. So if you're unfamiliar, what I mean by that, leaders cast shadows when they mismanage information. Those are these misrepresentations that happen here, the lack of communication or improper communication with clients and prospective clients. When they act inconsistently, that's that unfair dealing with their clients and business partners. When they misplace or break their loyalty, that's the failure to abide by that duty to clients, upholding that loyalty, prudence, and care. When they hoard privileges, the conflicts of interest that we see and the failure to disclose those conflicts of interest. When they abuse power, that is these acts of misconduct that we'll see. And when they act irresponsibly, when they fail to abide by the responsibilities of a CFA Institute member, they cast shadows. Next slide, please. Let's look at these violations on the whole. And what I like about this graphic is that it's very apparent looking at it, the many different violations in this case of the CFA Code of Ethics, or those shadows that I was just talking about. There are violations of professionalism. There are violations of duties to their clients, instances where there are violations of duty to employer. There are certainly conflicts of interest that we'll see. They fail to uphold the integrity of capital markets. There is improper investment analysis provided. And again, a failure to uphold your responsibility as a CFA member. I think at its core, it all kind of points to a lack of integrity. Jack Dorsey, DGIM, and their business partners lack integrity. Before you even get into the enumerated standards of professional conduct in the CFA Code of Ethics, it very clearly states an importance of integrity. You know, how a CFA should act and how they should conduct business. And I think if you use integrity as a kind of guiding light in your daily interactions and business dealings, often one arrives at ethical decisions. And so next, we are going to move into these specific violations, and I'm going to pass it off to David, who is going to help us gather some of those accumulated experiences in similar situations. David.
Thank you, Nick. In element 2, I'll be highlighting similar scenarios that have occurred in the financial industry that mirror the Dorsey and Gamby case. For instance, Enron WorldCom was guilty of insider trading, lying to investors and creditors, and falsifying financial statements. Enron was made to pay $21 billion to creditors, and many of those involved were sent to prison. Martha Stewart used non-public information to her benefit when she chose to dump her clone stock. Martha Stewart went to prison for 5 months for a conspiracy to commit insider trading. Robinhood is assumed to have stopped the purchasing of GameStop stock because of a long-standing relationship with Citadel, a known short seller in the industry. This case is currently under investigation. Sanctions and penalties are pending. I highlighted these cases because the leaders, companies, and individuals involved have all cast shadows of mismanaged information, privilege, power, and broken loyalties. Caroline will expound on how these scenarios are relevant to the Dorsey and Gamby case in the following slides.
Thank you, David. So in previous cases, we saw violations of misconduct, misrepresentation, and disclosure of conflicts, which are also violations in our DGIM case. However, there are many more violations, such as communication with clients and prospective clients, not telling them that Gamby was truly leaving DGIM, not being forthcoming with referral fees as seen in the ILSD fund, having and using material non-public information as Dorsey did when selling his and his family's share of WIEF fund, as well as short selling KC stock, misrepresenting performance presentation when they created brochures that misled clients in regards to the success of the ILSD fund, not acting with loyalty, prudence, and care towards clients as Northbound did knowingly with his split strike strategy, limiting the fund's potential gains and therefore clients' gains. And finally, responsibilities of supervisors when Dorsey allowed Peck to gloss over the due diligence investigation of the snake fund. Next, Marcus will wrap it up and let you know how we recommend moving forward.
Thank you, Caroline. So we recommend this protocol because it establishes organizational policy and structure. And looking at the overarching problem that the company was facing, which is its culture, we recognize that establishing that policy and structure is the first step we think the company should take in making the culture strong to abide by the ethical standards. So when we balance that intuition that we have from what we took away from the case, and also reasons from the ethical principles that we recommend applying, we can help the company move in a direction or behave in a way that is ethical and produce a culture that is strong and moves in the right way. So the two ethical perspectives we recommend are justice as fairness and altruism. Both of these perspectives provide a standard of putting the concerns and the interests of others ahead of yourself. And by applying these two perspectives, the company can eliminate any agency theory issues that might come about from the leaders placing their self-interest ahead of the interests of the clients. And by applying these two perspectives as well, they can abide by the Full and Fair Disclosure Act or standard and the duties to client standards. And they can also implement a reinforcement strategy in which the goals of a company are monitored, not necessarily just if the goals are met, but also how they're met, to ensure that the decisions that the company makes are aligning with the standards that the CFA requires the company abide by.
1 minute
This is the end of our
remaining.
presentation, and we will take questions from the panel.
Great, judges, it's up to you then. 10 minutes.
Great. Team 3, thank you for your presentation. I'm one of the judges, George Chin. And my first question to the team is, in your opinion, who was the worst violator in this case and why?
Oh, I'll go first. I think that Dorsey was one of the worst violators. For my opinion, for one, he had a bunch of information in terms of funds and non-public information, as you know, is disclosed in the CFA Code of Ethics, that he acted on. And then he also, in those meetings with the different fund managers, he heard about transgressions that they were doing or that were not in line with the Code of Ethics, and he didn't really do anything to persuade them or tell them that that's not, you know, correct or ethical. And he therefore, in my opinion, kind of hindered the whole spectrum, because he even told his clients, oh, it's okay to go with these funds, and allowed his clients to believe that these were ethical and correct funds to invest in.
I would agree if I could jump in real quick and just say, again, with Jack Dorsey, it was a misrepresentation of their firm right from the get-go, right? Like their whole business model was that he was good at marketing and she was good at investment. And when she steps down, they misrepresent that they are going to continue to provide that same exact service. And then, like Caroline said, I think, you know, the CFA Code of Ethics, you know, asks their members to promote integrity and viability of global capital markets, and maintain and improve their professional competence, and strive to maintain and improve the competence of other investment professionals. And he failed to do that in a number of these interactions that we saw in the case.
Thank you.
Hi, I'm Curtis Kimball, and my question to you is, can you cite me some examples in this case study, which is admittedly is exaggerated dumpster fire of ethical violations, but they are based on actual cases, which we can talk about after this is over. But can you give me some examples where multiple standards were violated? I noticed that you didn't actually cite the standard number, but from the context of your discussion, it's very clear you understand and have reviewed the standards. Can you give me some examples of where, in this case, multiple standards were violated for specific issues that were brought up?
Okay. All right, I will answer your question. I want to start with the very first issue, which was with Dorsey and Gamby. They made an agreement to make a role change in which Dorsey would become the CEO, the chief investment officer, but that was not necessarily his expertise. And they basically made that decision without, again, what I mentioned earlier, disclosing that information to clients, knowing exactly what the implications of that decision would have going forward in their decision-making process. And it was evident. I mean, when Dorsey was communicating with Northwood, Woodham, and Skip and Madison, it was clear that he was not aware of the standards that need to be followed in each of his reasonings in making those deals.
Yeah, it makes you wonder how he passed the CFA exam, doesn't it?
Exactly. Exactly. So it was really a trickle-down effect, because the minor issues, or not, they're not all minor, but the issues within the details within each part, I felt all reflected back to that conversation that Dorsey had with Gamby in that first violation. So that was the most glaring violation to me, because it seemed to have an impact on each of the decisions that were made. And the specific, so that would be the specific standard that was violated would be due to the clients and lack of full fair disclosure of information. And when you look at that and you look at Northblood's violations as well, I would say they were misrepresentation and duties to clients as well, because he had a strategy in which put his own self-interest ahead of the interests of the clients. And Dorsey, again, because of that lack of expertise in that investment role, he could not recognize that that standard was being violated. So he just went along with it. And they made the agreement, and as if no standards were violated when it was clear that they were.
Yeah, that letter to clients was kind of rich, wasn't it? Jack is now certified to manage all aspects of our firm.
Right.
Right. I think too, if I could jump in, there's an interaction between Jack, his direct report, Chauncey Peck, and Northblood, where he gives him a task, and his employee fails to follow the standard, right? He doesn't do the background checks that they're supposed to because they're old chums, right? They're good buddies. And I think that shows a lack on three parties, right? A lack of following these standards on three parties, right? He is not properly delegating as a leader. They're not doing the correct due diligence. There's not there's a misrepresentation. And Northblood himself, right? So like that's an instance where all parties involved committed like a myriad of different violations.
Right. Standard 4 duties to your employer also
exactly
involved in this. Okay. With respect to those issues, unfortunately, it's all too, it happens all too often among old white guys in the industry, the old boys network. So, are there any other issues you want to draw our attention to? I know we're almost out of time.
We want to talk about the Ford Woodman case, or part of the case as well, because we discovered many issues, many violations in that part as well. Specifically duties to clients, full and fair disclosure, and because Dorsey and Woodman agreed to give a fund to clients that was not on the decline, and then they were communicating, don't go with Care Construction because that fund is not, that won't produce the greatest return from the clients. When Care Construction actually, they had representatives saying, yes, this will be a fund to recommend, but Woodman was mainly just looking at his own interests. He's like, okay, Dorsey, we'll work together on this, but make sure we communicate to clients that this is not the fund, that Care Construction is not necessarily the fund to invest in, which is really, we thought was insider trading, which is an issue, because that's not something, that's not just a CFA standard, that's a legal standard that they're violating, which to get them in, they could face a lot of disciplinary action if they continue in those standards. So we definitely noticed that, and that was something that definitely needed to be addressed and changed if they wanted to avoid those issues down the road. And it didn't seem like either person in the situation felt that was a problem. They each agreed to that because Dorsey was, okay, you're helping me out, so that's all I care about. You're looking at my self-interest, but we're not taking care of the interests of the clients. And so the clients are benefiting from a fund that won't produce a great return, but Woodman and Dorsey are okay because they're covering for themselves, and that's a standard. Anytime a company is generating revenue, at the expense of the clients, that's an issue. That's an issue in any case, and that was the main one that we saw that was a problem that needed to be addressed.
No further questions.
Right.
Thank you, judges, and great presentation team. And so let's move forward.
Good afternoon, all. My name is Nolan McGinley, and I'm part of Raven Consulting. Let me show you the rest of the team.
Hello, my name is Chiboy.
And my name is Tariq Collins. And unfortunately, as I stated before, Cameron couldn't make it today because he had to work. However, he did contribute a significant amount to our consultation. For this case, we are Raven Consulting, brought in by Dorsey and Gamby from Dorsey and Gamby Investment Fund. And we're brought in to help revive this company. It has been made known to us that DGIM, or Dorsey Gamby Investment Fund, has made some mistakes with business practices, but most importantly, they, Dorsey and Gamby, being CFA charter holders, have committed violations with the standards of personal conduct. Today, we will discuss the events as they came about in chronological order, starting with the letter to address clients, the investment decisions with Snake Fund, Barks and Stevens, and Woodman Income Equity Fund.
We are introduced to Dorsey and Gamby Investment Management. DGIM is a feeder fund founded by Jack Dorsey and Miriam Gamby 10 years ago. They are CFA shareholder graduating with master's degree in finance. The fund layout is that Gamby is a chief investment officer focusing on selecting and conducting due diligence on master funds. Dorsey serves as a chief marketing officer, leading the client relations, marketing, and building the brand. The first standard violation we were introduced to were Dorsey and Gamby told their portfolio manager did not disclose their means of payment, which is a commission fee, refers a capital lockup fee, and this violating the standard 6C, conflict of interest on referral fee. After 10 years of service, Gamby is planning on retirement, but Gamby and Dorsey agree on not letting the client know. And Dorsey is promoted to be the CIO of the company, but they only inform the client that Dorsey and Gamby will now tackle investment together as a partner CIO. And this violating the standard 3A, duty to clients on loyalty, prudence, and care. And also the violations of standard 5B, investment on analysis, recommendation, actions on communication with client and prospective clients. Next, come about the meeting with Andrew Norbert of Snake Fund. Snake Fund pitched to Dorsey that he run the split and strike strategy, which correlating with the S&P 500 combined with the US Treasury bills. They guaranteed a 10 to 10.5% returns annually for the past 10 years. But given the strategy limitations and histories of Treasury bills, this is likely to be inaccurate. That means DGIM does not perform the due diligence on Snake Fund, which violating standard 5A, duty to client, standard 5A, diligence and reasonable basic, and standard 3D, performance presentation. Also, Dorsey and his due diligence team did not address Norbert Securities, it is executive broker and sub-custodian of the fund. And also, he net all of the outflow again on the inflows, which leading to the majority of the outflow again it never out of the fund.
Thanks, Chi. In this interaction with Skip Madison, Dorsey discusses Barks and Stevens' new structured product and agrees to offer to DGIM. One of the first violations made was DGIM not disclosing to clients the retainer fee they had agreed on with Barks and Stevens, as well as Barks and Stevens' index-linked structured deposit, claiming they could guarantee a 5% minimum return in the fund and a potential 40% max return, when in fact, Madison also expressed, since it's not a simple index tracker, it is based on 6 options of the index performance. According to the backtest ran by Madison and the team, there was close to a 0% probability that it would achieve a maximum return and a 50% probability it won't achieve the guaranteed minimum. This information was disclosed by Dorsey. However, he did not thoroughly disclose this to clients, or only promoting the initial pitch of a guaranteed 5% minimum return and a potential 40% maximum return in the brochure delivered to clients. Thus, Dorsey violated standard 6C, conflict of interest, subsection priority of transaction standard, and as well as standard 5, investment analysis recording actions, subsection diligence and reasonable bias. Finally, Dorsey goes to Ford and Woodman of Woodman Income Equity Fund to get an update about what he is doing. He comes out to find that Woodman has changed his fund from blue chip to a small cap fund, but Woodman did not disclose this to his clients and partners. Woodman has been seriously underperforming and producing less than 1% return to the market's 29%. Woodman also expressed to Dorsey has been 23 consecutive months of negative outflows. Woodman plans to close the fund and withdraw within a week. With this information, Dorsey chose to withdraw his personal and family shares in the fund, yet proceeding to tell his clients that Woodman had everything taken care of. This commits violations Standard 1, misrepresentation, and Standard 3, duties to clients. Woodman then brings up non-public information with Dorsey about another company, Casey Construction. With this information, Dorsey committed insider trading not only on his portfolio, but also on the portfolios of DGIM. This being a violation of Standard 2, integrity of capital markets, and Standard 1, professionalism, knowledge of law, because this is also an SEC violation.
As stated before, we, being Raven Consulting, was hired by Dorsey to help provide a solution to DGIM on their current dilemma. Priority being that Dorsey and Gamby immediately seek legal counsel on the proper legal actions needed to take place. Given Dorsey has committed a possible crime, he needs to reach out to his lawyers as soon as possible. Once again, we are a compliance consulting firm, not an attorney, so we cannot provide any detailed resolutions beyond the scope of our expertise. Secondly, due to their compliance violations and the violations of other firms, they need to dissolve any investment relationships with the companies mentioned above. Next, the company should communicate with their clients' operational changes with the release of pro rata refunding if liquidation is demanded. It is important to consider that if the company wants to continue business in the future, they must remove Dorsey and Gamby due to their negligence and failure to withhold CFA standards, appropriate business practices, and the law. Dorsey and Gamby should immediately implement a compliance team as well as a senior advisory board to help assist the new executive board members if they want to continue doing business in the future. However, as stated before, it is more probable that once the clients are notified of the current climate, majority, if not all, will urge the firm to release their funds, and it is also probable that clients will take legal action against Dorsey and Gamby. Once again, we are a compliance consulting firm, not a legal attorney. Everything we advise is simply a recommendation on our perspective of the case. We strongly urge Dorsey and Gamby to take steps on liquidating the firm because that is what most likely will be the feasible and unforeseeable solution. Now the floor is open to any questions.
Thank you. Excellent presentation. Judges, you may start.
By agreement, I'm going first. I'm Curtis Kimball. Tell me a little bit more about intentionality in this case. I realize that this case has exaggerated facts, but although it is based on actual events that occurred in various situations, and it is a real dumpster fire, so you're right, it would likely collapse in litigation and regulatory enforcement actions. But tell me a little bit more about intentionality of where you saw issues of people doing things either intentionally or unintentionally.
Absolutely. I can take that question. I would say that there is a multitude of situations where there should have been more diligence in these situations. I think one of the first ones was in the second part of this case, where it was talking about how an investment manager was not fully, it wasn't broken down fully, in that they only trusted what there was some prior knowledge of them before, but there was no actual full analysis of them, and that obviously breaking some ethics laws and whatnot. So I would say that was one of the first things.
Thank you. Next, Judge.
Yes, hi, Team 4. This is George Chen. In your team's opinion, who was the worst violator in this case and why?
Lots to choose from.
I can answer this question. I believe the worst violator would more than likely be Dorsey from Dorsey and Gamby, because he was pretty much the main player on most of these. He was the main decision maker on most of these situations. So I guess he would have to take most of the blame, and he would probably get perp walked out because it would be it was a lot of foul play in this case.
Makes you wonder how he passed the CFA exam.
Exactly.
Yeah. Do the other team members agree or have a different answer?
No,
Yes.
I would say the same thing as well. I mean, Dorsey was not very smart on some of his decisions with some of his investors and whatnot, and the people that he was investing with. So I would absolutely say that.
Yes, I also agree because Dorsey doesn't have much experience, and that's why he's make a lot of violations, and that's why he make a lot of fraud, and he must be the character that we should talk about.
Thank you.
Hi, this is Marilyn Kimball, one of the 3 judges. I want to spend a couple more minutes maybe delving into the part of the case that focuses on Woodman. You had some good points, but if you could, maybe just kind of talk about, would there been any actions kind of up front that would have, maybe changed the violations, kind of, if there was a course of different action, would that have changed the path?
Are you asking what actions would have changed, or?
I'm asking kind of putting the horse before the cart. Could they have done anything to not go down the path of all the violations?
Yeah, like most of the other, oh, I'm sorry.
What could they have done in the beginning to, kind of steer it in the right course instead of going south?
Like most of the other like most of the other investment relationships and strategies, Dorsey pretty much had a lack of consideration almost with his clients on the decisions he chose to make, because like Woodman didn't state his investment strategies, but Dorsey had this information, yet he failed to put the consideration of his client and the firm first. And so he just went on with decisions rather than making the best thorough decision with CFA, the law, and things of that nature. Like he recommended Woodman based upon simply just his reputation and him having a good relationship with Woodman, rather than him actually not being able to perform when it was 1% compared to the market's 29% in the last couple of years. Also with KC Construction, it's like, if somebody comes to you with non-public information, you should not act on that non-public information, especially with portfolio managers and all in the depth in which he acts. And I think it was kind of got out of hand. And like we said earlier, he kind of just went on and was just doing things based upon his own will versus what is actually the smart business thing to do.
And I would also like to add on to what Tariq said. When Woodman said he expressed there's been 23 consecutive months of negative outflows, I mean, there should be some type of thing to say at a certain point, you need to stop this, because this isn't a market, and this isn't what the United States economy is doing. There's a problem with your investments you're making.
Good observation. Yeah, there were a lot of forks in the road that if Dorsey had thought about, done a better job with this particular investment manager.
I have another question if you're finished, Marilyn.
Yes, I am. Thank you, George.
Yeah, and looking at your presentation, I didn't see any reference to standard 4, duties to employers. Is there anything in the case where that standard was violated?
Yes, I believe that there probably was a duty to employers because of the employer-employee relationships kind of between each firm, and how, but I feel like it was more so Dorsey knew this information, but he still acted on the information. So that's why I urge to not really put 4 in there, because 4 was more so like, if you know that your employee is not, that your employer is not thinking in your best interest, you're not going to act on this information still continue that relationship with that employer. When like in Dorsey's case, he could have simply chose other investment funds or other investment strategies, but he continued to still go on and make these decisions and do business with these firms. So that's why I urge us not to put standard 4 in there.
Yes, I also agree, especially when in the case with the snake fund company, one of the due diligence team member talked to Dorsey about how inaccurate it may be for the investment strategy, but they still agree that they still agree on the reputation of the firm, and that's why is if a problem with the management in a company. That's why we don't mention about the standard 4.
Yeah, to add on to what she's saying, like the due diligence officer, he came to Dorsey and was like, well, you told me not to do much due diligence on him because you said he has a good reputation. So at the end of the day, it comes back on Dorsey, once again, not calling the proper shots, if you will, on how things should be ran.
Thank you.
Great job, all. One more minute if needed. If not, we will adjourn and give the judges a break.
No further
I'm
questions.
good. I'm fine.
Thank you, team 4. Great job. We are set for a 20-minute break here for judges scoring, deliberation, and a moment of rest. So we'll let that timer go. Judges, please rejoin us when you're ready. And
thank you all for your time also.
Thank you.
So much.
Go right ahead, and you, team 4, are welcome to stick around to see the remaining presentations. Thanks again.
Thank you, team 4.
Thank you, and good afternoon, everyone. Thank you for taking time to join us. We're excited to show you our presentation. I'm Louise, we're team 5.
I'm Kathleen.
I'm Amitabh.
I'm Camille.
I'm Chandler.
So we started by using the CFA Institute's ethical decision-making framework when approaching the case. The first step was to identify situations in which ethical principles appear to have been broken, such as duties, laws, conflicts of interest, or insider trading. We then considered the influences and incentives for the individuals who were involved in these situations. Thirdly, we evaluated their actions and how they reflected good ethical principles or lack thereof, using the CFA Institute Standards Code of Conduct as a reference. And lastly, we reflected on the outcomes and challenges of upholding good ethical principles and posed potential solutions in order to help that in the future. So this is the table showing the major violations we found in the case. We have it listed in chronological order from the top to bottom. We found that the major violations fit 3 big descriptions. They were either lack of proper disclosures, conflicts of interest, and/or insider trading, and we will touch up on these violations in more detail later in the presentation. However, all these violations occurred in 4 major situations. The first one occurred when Dorsey was talking to Gamby about potential retirement and the change in roles. The second one was when Dorsey, Peck, and Northbutt were discussing the snake fund and due diligence into that. The third one was between Dorsey and Madison when discussing a new product for clients called ILSD. And lastly was between Dorsey and Woodman when talking about the Woodman Equity Income Fund as well as Kier Construction.
So for Dorsey and Gamby's first ethical violation, it was that neither of them disclosed Gamby's retirement or Dorsey's promotion and his extreme lack of experience. Secondly, neither Dorsey nor Gamby disclosed the lockup fee. This directly goes against the duty to not knowingly misrepresent any professional activities, as well as their duty to not involve themselves in any conduct that involves deceit. Additionally, this completely disregards the loyalty and care that they should have for their clients and their duty to disclose conflicts and referral fees. So we've identified that this violated standards IC, ID, 3A, 6A, 6C, and which is misrepresentation, deceit, misconduct, loyalty to clients, disclosure of conflicts, and referral fees, respectively. Next slide, please. So in the case of Dorsey, Peck, and Northbutt, Peck was assigned to finish the due diligence investigation on Northbutt, and he admitted to not performing enough reference calls or manager interviews due to Northbutt's stellar reputation and his relationship with Dorsey. We identified that this violated standards ID and VA, which is misconduct and diligence and reasonable basis respectively. Next slide, please.
In the case, Northbound acted as the broker and sub-custodian for their fund in order to offset outflows and inflows. We found that this directly violates standard 3B, as he failed his duty to fair dealing and the objectivity he must maintain with clients during investment and professional activities. Next slide, please. Dorsey again violated the Code of Ethics and Professional Conduct when he did not disclose the retainer fee and gave clients a brochure that misled them on investment return probability and even stressed this to a large client. We found that this directly violates standard 1C, 3A, and 6A. He completely disregarded his duty to not misrepresent any investment analysis, his duty of loyalty, as well as his care to clients. He also ignored his ethical obligation to make reasonable efforts to ensure the performance information is fair, accurate, and complete. In addition to all of this, Dorsey also broke his duty to disclose conflicts of interest. Next slide, please.
Ford Women's strategy change was not disclosed. He used to invest in large companies that yield 16% return, and now he invests in smaller emerging companies that yield less than 1% return. He omitted this change from the clients and also assumed more risk in doing so. Woodman then tells Dorsey about the WE fund closure, and he allows Dorsey to withdraw his investment prior to allowing clients to do so. Then Dorsey lies to clients for his own benefit, and he tells them that the WE fund is performing excellently while this is not so. This violates standards respond to misconduct, non-public information, loyalty to clients' performance presentation, and priority of transactions. Next slide, please. Now, Woodman, who is an insider in Kier Construction, tells Dorsey about Kier Construction's equity issuance. Dorsey then acts on this material non-public information and commits insider trading, which is illegal. He violates standard 1D and 2A, which correspond to misconduct and material non-public information. Next slide.
So finalizing this stage of the analysis, we decided to identify that Dorsey was indeed the worst actor in this case. This is due to his 6 main violations that we notice in the case. His actions were in direct violation with the CFA's Code of Ethics, and through a slippery slope, he eventually committed illegal acts, as we just mentioned. Okay, let's move on to our actions plan. Next slide. So for the short term, so all CFA Institute members, including chartered financial analysts and CFA candidates, must abide by the Code of Standards. Dorsey disregarded the notion of using reasonable care and exercising independent professional judgment when conducting investment analysis as soon as he became CIO. Dorsey and Gamby did not place the interests of their clients above their own personal interests, a requirement for CFA members. Therefore, we think that the CFA Society should bar them from their CFA designation. Further, it is necessary to make some immediate disclosures to the public. DGIM should announce that Gamby is retiring. This must be in language that is obvious as to not confuse the investors through technical language and actually explain each member's future roles clearly. They need to also immediately disclose the fee share and retainer fees. This should not just be disclosed behind 100 pages of prospectus, but rather it should be in an announcement where the details of the fees are written out. This is the bare minimum for immediate disclosures to the public, as these will be quick and easy to convey the situation and can be explained in a simple one-page announcement. All of the other violations made by DGIM will still need to be announced in more detail and will still need to be announced in the short term. Yet these are retrospective, so let's move on to fixing the long term. Next slide. So corporate compensation strategies should not encourage otherwise ethically sound individuals to engage in unethical or questionable conduct for financial gain. So for our first step, we decided that they should establish an independent ethics board, which will be required to have the same information of investments as do the investment managers. They will have the right and responsibility to change investment decisions based solely on ethics. Next, employees must develop a muscle memory that is necessary for fundamentally ethical people to make good decisions despite the reality that there are actual conflicting agents. So for our second step, monthly firm-wide ethics meetings will be held to go over ethical situations and their proper responses. Each meeting will require employees to consider ethics as a whole and make specific decisions where conflicts of interest occur. This will provide the muscle memory effect on employees. Also, an investment professional's natural desire to do the right thing must be reinforced by building a culture of integrity in the workplace. So thirdly, there should be a culture developed where younger and lower employees are able and challenged to speak freely with their bosses without fear. This will allow more open conversation and will make it easier to recognize ethical dilemmas. And finally, the company should make and publish a document listing all fees relevant to clients, regardless of their nature, on a continuous basis. All of these steps that I just mentioned are needed to ensure the integrity of the industry and for the benefit of society. Next slide.
So to conclude, we started the presentation by identifying scenarios which we believed appeared to have broken ethical violations. We considered how the people in the situations represented the CFA standards of professional conduct, and in many cases did not perform according to those standards. We looked at their actions and the ways in which they did not reflect on sound ethical principles, and we reflected on solutions and controls to implement in order to avoid future problems. We found major violations in the three big areas being lack of proper disclosures, conflicts of interest, and insider trading. And we found that all the characters in the case were extremely cognizant of the violations which they were doing, but they continue to do it for their own benefit. And that concludes our presentation. Thank you for watching, and we are now open for questions.
Thank you, judges. You may begin.
Hi, this is Marilyn Kimball, one of the judges. I was wondering if you, depending on who wants to take this question, spend a little bit more time talking about Banks and Stevens, that situation in the case. And in reading through it, would you recommend any initial actions that could have been taken to not go down that slippery slope of violations that ended up occurring? Could they have done it? Could they have done anything differently in the beginning with the Banks and Stevens situation to kind of right the boat?
I'm sorry, you cut off for me at the end. Could you repeat between Dorsey and who?
Between Dorsey and Banks and Stevens. You know, where they were talking about their new product.
Oh, yes. I think
that particular part of the case.
Yes. I think Dorsey should have looked a lot more at the initial brochure that was presented to him and a lot of the data. I believe within that brochure, the way they tested it, they maybe misplayed the possibility of it losing money, and Dorsey should have kept his clients in mind rather than just looking at that as a product to get more commission and enrich himself.
Yeah, and just to add on to that, with the brochure, he really stressed all of the gains. On that first page, it talked about the font size and the print, and that really went directly against the whole procedure and the standards of ethics to not do any misrepresentation to clients. And the way he stressed the gains in the large font size, and he didn't put the probability of the minimum return until way later in the brochure in the regular size font, really showed how he was trying to misrepresent the likelihood of the minimum return versus the potential maximum return, which was almost impossible to achieve based off the case study.
Thank you.
Hi, I'm Curtis Kimball, the next judge, asking you a question on this matter. On slide 6, you discussed Dorothy, Peck, and Northbutt and noted the ethics violations with respect to due diligence investigation. Do you think that Peck and Dorsey, in terms of the employer, and I realize this whole case study is a dumpster fire of ethical violations and will not end well for any of these people. However, these are based on actual things that have occurred in the market. We can talk about that after this is over. What do you think about the duties that they owed to their employer? I'm interested in your thoughts on various multiple violations.
Yeah, absolutely. Oh, sorry, there's some feedback on that for some reason. But yeah, absolutely. I mean, as an employer, the standards of ethics really talks about the duty the employer has to the clients overall, and they need to make sure that they fully understand all of the what goes into the investment so they can portray that accurately to the client so that they can make a sound decision. And to just completely disregard some of the full analysis that they said they would have conducted had there not been a relationship there really stressed the fact that this was misconduct solely for the fact that they had the relationship. And I think that goes a big part into them needing to understand all of the things that go into an investment as the employer, the investigator, and the person recommending the security to clients to ensure that all of the advice given is sound, ethical, and legal.
Yeah, unfortunately, it's all too common in the old white boys network.
And to briefly add just a quick touch to that, we all believe that the duty to clients is way above the duty to employers, and that should have been the first thing that they focused on.
Yeah, and even Peck, who's a junior, or seems to be more of a junior analyst, he's a CFA candidate, and even as just a candidate, someone who doesn't hold the right yet, they still need to abide by that code of standards and do the full due diligence.
Yeah, this case makes you wonder how Dorsey passed the CFA exam, doesn't it?
Right.
No further questions.
Oh, thank you.
Hello, Team 5. This is George Chen. And my question is, Standard 7 discusses the responsibilities as a CFA Institute member or candidate, and specifically Part B is a reference to the designation, the institute, and the program. Was there any violation of that in this case?
I can take that question. I think at a very big level, almost everybody involved in the case was also part of the CFA Institute indirectly or directly with a charter. And I think broadly speaking, there was a lot of cases of misconduct in everybody within that case. And like I mentioned later in the presentation, it appeared that every character here was cognizant of the violations they were making, and they continue to do it. So I do think that is a big one for almost everyone in this case.
Yeah, then adding on, oh, you can go ahead.
Oh, my bad.
I'm sorry. Just to emphasize on that, intent is a very important thing to look at, especially because courts look at it and we can see that we have illegal actions being performed, such as insider trading, which were intentionally acted upon. And that action of shorting the shares set that intent forward, and it kind of just exemplifies what intent really is.
To build off of both of those statements, you referred specifically to Part B. Although there wasn't mentioning specifically of someone exaggerating how far along they were in the CFA process, I do think Part A of 7 was a huge part of this case, as a lot of people, I mean, hugely tarnished the CFA reputation. It talked about someone being a candidate as well as other chart holders, and to do the misconduct that even all of the standards say not to do, but especially 7, just when it sums it all up, they really misrepresented and disregarded the reputation that the CFA holds and the ethical meaning you're responsible for once you do achieve that standard.
Thank you.
Any additional questions from the judges? If no additional questions, thank you for a great presentation and Q&A response, and we'll move on to the break.
Thank you, Team 5.
Thank you.
Good evening, everybody. We're Team 6. I'm Adolfo. We have Amish and Hunter on our team. Amish is going to present first, followed by Hunter, and then me.
All right, so the first standard, so 6A, disclosure of conflicts, was found on page 1, where highlighted word not to disclose this fee to clients because the arrangement is between the Dorsey. So disclosure of conflicts, members and candidates must make full and fair disclosure of all matters that could reasonably be expected to impair their independence and objectivity or interfere with respect to duties, their clients, prospective clients, and employer. So in this case, Dorsey and Gamby has violated standard 6A by failing to disclose to client about the fees.
All right, the next violation is going to be found on page 2. It's when Gamby's informing Dorsey that she is retiring. She says that we will not tell them that I am retiring. And further down, she goes on to say, he has worked close with me in overseeing all aspects of the firm. Both of those highlighted statements are untrue or misleading, which makes them violate standard 1C of misrepresentation. So anytime, obviously there wasn't a continuity plan in this for when she did retire. And that's the problem with this violation, is that there wasn't a continuity standard in place for when she was to retire.
The following standard is 7B, which is in sending a letter, which on page 2 also, to the clients, telling that Jack, now that he's certified as CFA, he's certified to manage all the aspects of the firm, which is an appropriate reference for the reason that you cannot be certified, but you can tell that they're knowledgeable about the term.
The next violation is standard 5A, just diligence and reasonable basis, which basically means that every investment decision is based on a set of fact known and understood at the time. And as highlighted words, I did not conduct as many managers interview and reference calls as I would have normally done. I saw no need to review his firm's code of ethics or his compliance and internal control procedure. In this case, the auditor has violated standard 5A by failing to perform sufficient due diligence.
All right, and the next violation is found on page 4. Northbound Securities is acting as both the executing broker as well as the sub-custodian, which isn't necessarily a bad thing, but if something were to happen and let's say you had a client get mad, well, they have a conflict of interest to point to now, and they can mitigate that risk by just using a third-party custodian, which is common practice. So therefore, that violates standard 1B, independence and objectivity. You can't maintain objectivity if you get compensation off the sale of a security.
Then on page 4, we have Dorsey saying, wait, I think I moved. Yeah. We have Jackson. Okay, so we have Dorsey saying not following up with the standard 4C with the responsible supervisor by just creating a feeder form, which doesn't make the effort to responsible effort ensure that everybody is subject to their code or standards of the firm.
The next standard is 6A again, disclosure of conflicts. And in this case, must make full and fair disclosure of all matters that could reasonably be expected to impair their independence and objective. And in this, as it highlighted, all the firms, including ILSD, DGIM, and Barks and Stevens, they were talking about a retainer fee based on the value of clients' assets still invested in ILSD. And then also the other one is we do not have disclosed the fee sharing arrangements or the retainer fee to clients because those are just between Barks, Stevens, and DGIM. In this case, all three of them has violated Standard 6A by failing to disclose to clients about the fee sharing arrangements.
All right, and the next violation's on page 6. The language in this sentence was just can be very misleading. A potential maximum return of 40% at maturity, and they didn't state that this was simulated performance. If they would have said this is based on historical performance and the difficulties in making estimations off historical performance, then maybe you could say this is okay, but because they disclosed it. But this is just bad language and could be misconstrued by the client and give them unrealistic expectations or unrealistic chances of this happening. And that's standard 3D performance presentation.
And on this sentence on page 7, they didn't want to disclose the changes on their policies, which violates standard 5B, communication with clients. Like not disclosing the change on the clients about their performance or how their investments going to be in the future is going to be unethical for them. Like you should tell them if they want to change the firm or they want to continue with you working.
The next standard is standard 6B, priority of transaction. And as this was found on page 7, the highlight word, give me the time to withdraw our money from the fund before you close the fund. So basically Dorsey violates standard 6B by acting in his own and family and creating an advantage, knowing the fund will close the possibility of share price decreasing.
All right, and the next violation is found on page 7. The highlighted part reads, clients reaffirming your investment acumen and expertise, no need for me to say anything to them about your change in focus. Well, anytime there's a change in the IPS, that should be disclosed to the client because now their vision might not meet the firm's vision or the fund's vision, and they might not want to be a part of that anymore. So if you don't disclose that, they don't have that opportunity to make their own decision. They may think that, you're still making responsible investments and now you're buying tobacco stocks or something of that nature. So that can just not be fair to the client and it violates standard 1C, misrepresentation.
And we have right here stated by a woman that he sold his entire fortune after knowing his meeting with Dorsey. And also Dorsey does sells his own shares and family wife. Like they violate standard 2A material nonprofit information by acting with knowing the information.
All right, next one is standard 2B, market manipulation. This was found on page 8. DGIM clients and investors who are withdrawing their money from WIEF are making appalling bad decision. DGIM retained the conviction in Woodman to deliver excellent long-term performance. This basically, DGIM is publishing false information with the intent to mislead market participant.
All right, and last but not least is found on page 8. It's standard 6B, priority of transactions. States later that same day, Dorsey ends up telling his clients, it's time to sell. Well, this was after he already sold his position and took a short position.
1 minute warning.
In the construction company. And personal trading, especially if you're acting at fiduciary standard, comes secondary to client trading. You can't trade for the benefit of yourself and then go trade for the benefit of the clients, especially if it's the same security. So that's why this violates standard 6B, priority of transactions. And I think that's all we have for y'all. Thank you.
Thank you, Team 6. Good job. And we will send it to the judges for 10 minutes of questions.
Thank you.
Hello, Team 6. This is George Chin, and I'll ask the first question. In your team's opinion, who is the worst violator in this case and why?
I think I can answer that. I want to say it was Dorsey because he acted on material non-public information. And that's probably one of the biggest no-nos, I would say. And as well, that affects everyone who is a participant in the market, not just clients of that single firm. So there's more affected, in my opinion.
What do the other team members think?
Yeah, I was also thinking about Dorsey because there's more violations talking about her and also the non-disclosure information. I'm like, if it's not disclosure, don't act on it unless I'm like, you already made it public, you already made to your clients and inform them about what is the market. I'm like, you cannot act on it.
Oh yeah, and I also like to add one, like there in the case study, there was a time where they were trying to audit this one company and how just because Dorsey had a good relation for 15 years, I believe the name was Pack, I think, when when they performed a audit, they didn't do the right way because since they knew Dorsey knew the person for 15 long years, they decided not to do a proper audit. So I do agree with Hunter that Dorsey overall in this entire article, Dorsey was like committed like the most violation of ethics.
Thank you.
Hi, this is Marilyn Kimball, one of the judges. I'd like to do a little bit deeper dive in the situation of Banks and Stevens, the new product, and you highlighted several of the violations. But if you could kind of walk us through maybe actions that should have been taken up front that would have avoided some of these violations.
Can you reference me to where that's found at one more time?
That's the Skip Madison, the Barks and Stevens, where they're talking about the new product, the win-win-win product for clients.
Oh, okay. Okay.
What could they have done differently? Kind of a little bit more deeper dive into that part of the case.
Well, I want to say the one disclosure we found, or the two violations we found in that were the retainer fee and that they didn't disclose the retainer fee. Are you wanting us to
just
dig
kind
deep?
of do a little bit more discussion of what was wrong and maybe what the right action would have been?
Okay.
Well, to me, I would say that the right action would have been that I feel like ILSD would have better that they would have informed their clients about receiving all this, the retainer fees and everything, as well as inform both of the Barks and Stevens and DGIM to let them know that, hey, it's better to inform your clients as well that this is the action we will be doing. So I would say that I would have done differently. So everyone would have been in know that what's going on with all those three firms.
And what about the brochure?
Brochure.
The brochure.
All these same.
just the marketing side, the new brochure and some of the problems with that?
Where they bring up the 40% potential maximum return?
Yes.
Okay. Well, the first I'd say is the potential maximum return of 40%. I just don't understand why you would give an exact number or even state something like that, because then it gives people the expectations of that. And if it's whatever your back test said the percent chance of that happening was, the clients are going to get the wrong idea about it. So maybe just give a pretty big disclosure if you're going to say something like that, instead of just throwing it in there without the proper disclosure that it was done through a back test and whatever the percent chances of that actually occurring are, so the clients have a real expectation of that occurring.
I also wanted to add to that. I'm like, it's also hard to back up that information to the client. Oh, this is the reason why we have this percentage. I'm like, we can provide them with almost a realistic number that you know for sure you can over exceed and actually make it smaller numbers so the client feels safe with your investments.
Okay, thank you.
I'm Curtis Kimball. I have the honor of being the last judge to ask you questions. I know this case is a dumpster fire of ethics, so but it is exaggerated, but it also is based on actual occurrences too. I'd be interested in your thoughts on multiple violations or multiple violations of the standards. In other words, can you give me an example in this case study where you have somebody doing something where they violated more than one of the standards? You've been great in setting forth the each standard, but I'd be interested in your comment on pointing to a situation where they violated 2 standards, 3 standards, or even more.
So in slide 15, the priority of transactions, not only did that violate that, it also was acting on material non-public information because it hadn't been released to the public yet. So the right thing to do is not to say anything. You can't even trade it in clients' accounts if you know it, because that's material non-public information. So that's an example of where they violated 2 standards.
So what do these folks do at this point in time? What's their plan at this? It's probably going to end badly. Do you have any plan in mind if you were them? Makes you wonder how Dorsey passed the CFA exam, doesn't it?
Yes.
I know. To be honest with you, I don't think he had a plan. I think he was just running by the seat of his pants at this point. But
what would you do?
Ooh, I'd have so many disclosures on my ADV. I don't know if I could go anywhere else. Let's see.
Can you restate the question about like, what would we do before, like during it's happening or after everything happened?
Obviously the dumpster fire is in progress. So yeah. How do you resolve the issues that the case presented at that point?
Okay.
Sell my position, sell all your clients' positions, give them their money back, and go into a different industry, I'd say. But most importantly, I think you need to, you're under fiduciary standard. Your clients need to come first. So you need to get whatever return you can get or whatever you can get out of that fund to ensure that your clients can at least have something and they're not just going to zero at this point. I'd say that's the correct step to take.
Okay, thank you very much. I have no further questions.
We are ready to transition. We only had a few seconds left anyway. So thank you, Team 6, and thank you, judges. And Kathy, I think we can go to the
Thank you, Team 6.
Yes, thank you, Team 6. Great job. And with that, that concludes all of our live presentations. We're going to let the judges again return to their breakout room for for scoring and deliberation, and we'll have an additional 10 minutes just for everybody to stretch and have a comfort break. So just be mindful, we are running ahead of schedule, but again, we're going to do the complete allotted time for our break here. And then we'll move on to our closing presentation and winner announcement.
All right, guys. Well, this was a very exciting day and very exciting competition. So thank you so much to everyone for participating. And let's start with our presentation and we'll find out very soon who won the competition as well. All right, so first I want to thank all of the volunteers and the staff from CFA Society Atlanta who worked on preparing this competition. So Kathy Ford, our executive director, and Deborah Martinez, our society associate. Thank you so much for all of the work that you guys have done and organized this competition. Celia Anderson, who was today our timekeeper and also put a lot of work into working on this competition. And she is our VP of Education and University Outreach. So hopefully you guys are interested in joining our CFA Society Atlanta. And we actually have a special, there is a special membership that you can have, which is, there is a discount for students. So you guys can actually pay just $45 a year, and you can actually join it. Typically, the membership cost is $375. So it's a very big discount. And again, online application requires that you guys need some member sponsors. So if you don't have anybody you're interested in joining, but you don't have any sponsors, please reach out to us, reach out to Kathy or to our membership committee, and we will find sponsors who would be interested in providing their sponsorship for you to join. And the membership benefits we have a lot of benefits to become a member. And I think, when I was a student, I would have been very excited to join something like that. But, I had no idea that there is a CFA society and there is actually students would be interested in joining it. So let's kind of go through benefits which are available for students. So there is a networking amongst the members, guests, and other local industry professionals. There is a mentorship program. There is a robust speaker programs, education through our online live events and past event archives. There are also soft skill and career development programs. There is also social media shares of blog or CFA Institute materials. There is also opportunities to engage, educate, and give back to a local community. Also opportunities to volunteer and join a leadership team. You can also help through ASFIP Foundation to help out with local financial literacy initiatives. So hopefully you guys are going to be interested, and all the details can be found on our website. If you are interested in actually having a CFA charter, we have some resources for candidates. I guess you're familiar with requirements of passing 3 levels for becoming CFA charter holder, and we have local study groups. We also have online mock exams for anybody who is interested in becoming a candidate. So we also have programs and support provided by CFA Institute, and also our partner Kaplan provides resources as well. And you guys can have some discounts if you're interested in getting some Kaplan Schweitzer exam prep materials. So again, you can go online and learn more about those resources. So let's talk a little bit about today. And we had a fantastic competition. And thank you so much for our esteemed judges George Chen, Kurt Kimball, and Marilyn Kimball. I think we had very interesting questions, and thank you so much, guys, for being the judges and providing the questions as well as being the judges for this competition. And this is how we were scoring the presentation, where judges were filling out these forms, so you guys can see on the screen. And typically the way they were looking at violations of the standards of professional conduct, course of action and solution. They were looking at persuasiveness, and they were looking at team involvement. So wanted to make sure that the team, everybody was participating. And now we can give you the names of the universities for all of the teams that participating. And thank you so much, teams, for participating, and thank you to the faculty advisors as well. So as you can see, teams 1 and 4, these are teams from Georgia State University. Team 2 is Agnes Scott College. Team 3 is Mercer University, Atlanta. Team 5, Kennesaw State University, and Team 6, Georgia Gwinnett College. And now let's find out who the winner is.
And just to build the anticipation a bit more, it was a great competition and it was a really hard choice for the judges, but I'm also going to let the judges provide just some generic feedback before we actually announce the winner. Simply because we want everyone to join the actual networking later, but not everyone does. So we would love to see you there for more engagement and more feedback and to know you a little bit more. But I'm going to pass it back to, actually, I might start with Kurt, or whomever wants to say something from the judges would be great.
I actually thought all the presentations were good, had aspects of creativity in all of them in terms of looking at this, as I said, dumpster fire of ethics issues. So it is based on a number of actual situations. If you think about it, the Snake Fund and Andre Northbutt is actually Bernie Madoff and his funds made in a slightly different format. So that creates the issue of the feeder funds and the ILSD with not 1, not 2, but 3 fees getting undisclosed or not adequately disclosed. So there's a number of issues. The inside trading issue is actually based on David Einhorn's Greenlight Capital Fund, where he was heavily fined for that situation. So there, as I said, these are exaggerated versions of real life issues, but they are very much there. And we thought that you all picked up on those major issues. So everybody did put in the time and did do really good work. And it was hard to determine, quite frankly, who the ultimate winner would be in this case. So that's my comment. I'll turn it over to the other judges.
I'd like to just add that I was really impressed with all the presentations and the slides being very detailed due to all the different variables in the case, and really doing a good job on the presentation and kind of laying out the violations and the standards and you know what you would do in those kinds of things to come up with solutions. Also really enjoyed seeing all the faces, all the presentations, and all the Q&A really worked well in kind of filling out your thought process on looking at this case. So kudos to all of you for your work leading up to today and spending your Saturday with us and doing the presentations.
George, any final comments?
Yeah, I want to thank all of the participants and the faculty advisors for their participation in this inaugural event for our society. We hope to make this an annual tradition, and hopefully all of you had a good experience with this. Please feel free to connect with us on LinkedIn. And as Natalia mentioned, we would love to see you as a member of our local society and maybe see you at our events. And I want to say good luck in your future studies. And if you do consider a career in this industry, you know, going through this case, some things are not necessarily black and white. Sometimes it can be different shades of gray. And, you know, having that grounded, you know, moral, you know, ethical, you know, framework and foundation will lead you to making the right choices in the end.
Thank you, judges. And I can say, because I was in the breakout room with the judges, this was really a tight call. It literally came down to just a point or two between a couple of you. So the winner is team number 5, Kennesaw State University. And I think we have a chart here. So congratulations to team number 5.
Yay. Congratulations.
Well, thank you so much. It was a great learning experience.
Yeah, thank you guys so much for the opportunity to do this. We really learned a lot going through it, and I'm just really grateful that we won, and everyone did a great job from what we saw.